Hello, hi everyone. Thank you so much for making time to learn about RevRec use cases today. We'll take just a couple of minutes as people start to settle in. I know it's a busy Thursday afternoon for some of you, maybe Thursday morning. So I'll let you grab that coffee, close some Slack notifications, and get comfortable while we get started. While we wait, I would actually love to see where is the community dialing in from. So if you could put it in the chat, where are you joining from, the location, your role, that would really help. In fact, let's make it more interesting. If you could put in what one word describes your current RevRec process, I think Jill and I would learn a lot more about, how you think of RevRec today. So let's see if the chat is working as well. I can say hi. I see Pratap is from New York. Hmm. I don't see much activity in chat. I would request the admin to check if the chat is enabled. Awesome. I see some more participants trickling in. Good to have everyone join. Just saying it again. Would love to hear where you all are dialing in from. I think that's the part of live webinars. We get to see so many people joining from different parts of the world come together to learn. Um, I see. Hung is joining from Prague. That's amazing. Thanks so much for taking our time for this. What is it? What's the time there? It's must be late evening or something. Yeah. Oh my God. You really have a lot of RevRec use cases that you want to learn about. That's great. Awesome. Let's dive right in. I'll also present my screen to make sure that we are able to test that out as well. Just hold on for a sec. Awesome. Perfect. Sorry, my screen is stuck. I'm so sorry. These webinars are always a technical challenge. I'm just going through one right now. My screen seems to be stuck, but I think it's fine now. Okay, awesome. Cool. So, welcome everyone once again. My name is Priyam Sodhia. I am the Director of Marketing and Partnerships here at Zenskar. Before we begin on our expert guest, let me quickly tell you about Zenskar. Zenskar is an AI native order to cash platform built ground up to automate order to cash operations for modern finance team. We work with B2B companies that are growing fast but don't want to scale headcount to keep up with billing and RevRec operations. We automate billing, revenue recognition, reporting, all that just by taking in your contract data and usage data as source. We also have conversational AI agent that works as an extension of your team. A lot more good stuff there that we're able to do with AI, maybe for a personalized demo that we can cover that there. Before I almost forget, I would love to introduce our guest, but at the end of this webinar, we'll also be giving away Amazon gift cards to one or a few more lucky winners who share their RevRec challenges in chat and stays with us till the end. So make sure you stick around until the end and you could be the winner. All right. Without further ado, I would love to introduce our expert today, Jill Hauck. She is the founder and principal consultant for 12th Norwegian. She is an expert in code to cash, ASC 606, and revenue operations. Jill has spent over 10 years helping SaaS companies navigate complex scenarios. She specializes in ensuring your revenue recognition doesn't just satisfy auditors, it actually reflects how the business operates and scales. Jill, thanks so much for joining us today.
Thanks so much, Priya. I'm excited to be here. Just wanted to, I think, point out the screen doesn't seem to be sharing. Um, do you want to try one more time, or I can share if that's easier?
Let me try that. Does it
But
work
while you
now?
do that, there we
Ah,
go.
yeah,
I'm seeing myself now. Perfect.
perfect. Awesome. Cool. We also have Ashrita from the team. She's the head of solutions at Zenskar. She works hands-on with finance teams every day to automate their RevRec workflows, and she'll be showing us how these edge cases get handled in practice when you have the right automation in place. Ashrita, great to have you here.
Excited to be here, Priyam, and nice to have you here as well, Jill.
Thanks so
Awesome. Before we dive in, I'm curious to hear a little bit from the audience on which RevRec edge cases are they currently dealing with. It would be great to see where they are. So, can we have the first poll, please? So, which scenario are you currently dealing with? Of course, we are going to cover all five of them, but it would be interesting to see what our audience is, kind of facing today. Awesome. We'll give it a few more seconds so that people can put in their answers. If there's something that you don't see here and you would like us to cover or maybe take that up as the Q&A, please feel free to post it in the chat and we would be happy to cover that as well. Awesome. Cool. Can we have the poll results? Awesome. I see a majority is definitely seeing bundled software and implementation. And we have equal number of interest in mid-contract upsells and multi-entity hierarchy. Those are very interesting ones. Awesome. This is very, very helpful. Cool. So I think without extending this a little bit at all, I would love for Jill to kind of walk us through a few of the most common edge cases she sees and controllers struggle with. Let's get started. Jill, over to you.
Thank you so much. Can we go ahead to our first scenario slide? Let's talk about bundled software and implementation. I think seems like this is a hot topic based on the poll, so maybe we could spend a little bit more time here than we do in the other ones. You're going to hear me say this probably a lot, and this isn't something you can say to the auditors, but it's something to think through. So the answer is it depends on how you handle your RevRec and your operations for bundled software and implementation RevRec challenges. So let's start with the policy side of things. So the RevRec policy, you're going to need to evaluate this in your second criteria. So what are your performance obligations? And so in that section, you're going to evaluate, is this one performance obligation or two performance obligations? And that's going to be different based on how your product is sold, how it's serviced, developed, different things such as that. So if we want to think about two different examples, an example where it would be one performance obligation would be where the implementation has to be performed in order for the service to be used or for the product to be used. So let's think maybe like a healthcare type of software offering where you're required to constantly add implementation services to that, do additional things for that to get up and running. Whereas on the other hand, something where it might be separate from a revenue perspective would be Salesforce. I think Salesforce is a pretty known product that's a CRM where almost anybody can implement it, including yourself. And so if they sell implementation services to you, those are two separate performance obligations. One is to deliver the software to you, and one is to actually perform those implementation services. And so in the situation where it's two, then you're going to evaluate, is that revenue recognition term different? So maybe one's over 1 year versus the implementation might be over, let's say, a couple of months. So there's going to be a number of different scenarios based on how your product, again, is implemented and serviced. So that's the revenue policy side. But then when we think about the operational side of it, you're going to have various scenarios. So maybe you ultimately decide from a revenue policy perspective that it is two performance obligations. And so in your system, you need to recognize them separately. However, we know salespeople can be creative and like to sell every different way. So they may bundle the sale where they say, okay, the customer's only going to pay $100, and that's for both of these products. You, on the back end, from a revenue accounting perspective, need to separate that and recognize those separately based on what we just talked about in terms of the policy side of things. And so that's where systems come into play, because you can enable your salesperson to sell various ways and then have rules on the back end to account for those, whether it's one performance obligation or two. That, I think, sums up the bundled software implementation. As Priya mentioned, if you have follow-up questions, feel free to add them to the chat or save them for the end. We can do some Q&A or additional follow-up on this topic. Okay, let's go ahead and move to the next scenario, please. Okay, so here we have the situation of hierarchical billing. So what that means is maybe we have one master contract with, let's say, an IBM, and multiple departments within IBM are buying your product. And so they may need different invoices for each one of those, but it's under one master contract. From a revenue perspective, there's various ways to handle this. The first thing that you're going to need to evaluate is, what do you consider the contract? So that's your first step in ASC 606 is your contract with the master party, and is that just that master contract, and everything that is under that contract is considered one agreement? Or do you have maybe one master contract with purchase orders that go under that agreement as various agreements? And that's going to determine your revenue accounting. However, you may want to report from a business perspective, or maybe the customer wants to see a consolidated bill. So we need to remember that the benefit of ASC 606 is that you can separate revenue and billing. And so in the scenario where we say it's one contract, and let's say there's multiple invoices under that contract, what's important from an operational perspective is to have a unique identifier to tie that information back together. So whether that's on your invoice record or your billing address record, right? There's multiple ways you can do this, but it's about having that tag that can be rolled up into one, either reporting structure or, again, a master invoice that's sent to a customer. And then ultimately that billing related transaction can be tied back to your revenue contract. So again, those are separate, but we still need to do a reconciliation and ensure that we're billing for the revenue that we're recognizing. Okay, this one didn't seem to be as big of a hot topic, so I think we're going to be good there. Let's go ahead on to the next topic.
Awesome. Before we do, I just wanted to make sure that we remind participants to post questions in chat if they have any. And I see a question, Jill. Let's see if we can answer that. How do you handle it when a customer initially self-implements but then requests professional services midway? I think that's an interesting one.
Back to scenario one. Yes. So I think that also is going to depend again on what are those services you're providing? Are those services required for the customer to use the platform? And if so, then you're going to actually need to go through the contract modification framework and evaluate if there's an impact to the revenue you've already recognized for that customer. Alternatively, if you say, again, let's go with the Salesforce example. Let's say any third party could do it, but for whatever reason, the customer has agreed that they want to do it with you. Well, then that could actually be a separate contract, and you just recognize your revenue based on whatever's in that contract, separate from the original agreement. Any follow-up questions there? That one can be a tricky one, but it's really dependent on how your product operates.
Jill, do you want to maybe take an example and add more color to this? Anything that you may have seen in the industry where, there was products or bundled with a service, and you saw something where, the edge case was handled in a particular way. Anything that would help our audience understand this a little bit better before we move on to the next case?
Um,
I can throw the same question to Ashita later in case you don't have an example. I'm sure she would have something.
I have a complex one. It's a bit old, but it's complex and it was auditable, but it was a healthcare type of business where the implementation was required for the customer to get up and running. And there were multiple products within the sale. So let's say there's 5 different SKUs, and each one of those SKUs required their own implementation. In that situation, we essentially every quarter had to evaluate where the project was. So not a percent completion, but essentially we had at the onset of the agreement said, we expect product 1 is going to go live today. Product 2 is going to go live in 1 month. Product 3 will go live in 2 months. Product 4 will go live in 4 months, etc. Every quarter, we would have to go and evaluate, is that estimate still accurate or reasonable? And if not, then we would have to go through the contract modification framework and assess and change that RevRec because we had a bundled service with the product, and that changed the allocation of the products over time. Again, very complex, but hopefully that is a little bit more of an edge case that might help people.
Absolutely. The webinar is for edge cases. So if you're not scaring people enough, then we're not doing a good job. But I think that was very helpful. I'll again request audience to keep posting their questions. We're happy to take them during the webinar or towards the end. But in the meantime, I'll move to the third scenario. Jill, over to you.
Perfect. Okay, number 3. So minimum commitments and unused capacity. So this is clearly much more of a hot topic these days. I think, in the world of AI and usage-based, outcome-based pricing, people are going to see this a lot more in terms of I'm going to commit to a minimum versus I want to pay you a SaaS type of contract monthly fee. So when you have unused capacity, you don't know that up front, right? And so that's where the complexity comes in. And so when we think to the 5 steps in ASC 606, this is going to be in your transaction price section when you think about what is your variable consideration. And in the very technical world, you're supposed to estimate what you think that usage is going to be. Or you just recognize what's actually used every month, and then you have a large spike when that amount is unused at the end of the month or the end of the quarter or the end of the year, whatever your measurement period is. Now, there's a few things you're going to have to evaluate when you're looking at that unused capacity. One being, do you refund that? Does that become a credit? If that doesn't roll over, if it doesn't become a credit, if it's not something that the customer can use after the end of your committed term, then again, you're supposed to evaluate what is your estimated usage during the term, and then evaluate that every reporting period to say, is my estimate still reasonable? That's very technical guidance. That's how the book says it, but that's not operationally feasible in a lot of companies. And just frankly, for a lot of people, it doesn't make sense to do it that way. And so what a lot of people will do is just recognize a straight lined value and then do an evaluation, a sensitivity analysis at the end of the period to say, even if I recognized what they actually used versus the straight line value, it wouldn't be materially different. So when you think about minimum commitments, a lot of times it is about that upfront evaluation. And you, from a policy perspective, have to make the election of, do I want to make an estimate now? Do I want to take a practical expedient to just recognize what's essentially used or invoiced? And then there's a business decision of, do I want to have a very consistent revenue stream, or am I comfortable with a spiky revenue? Meaning I recognize it at the end of the period. So again, this really comes down to business practice. If you're refunding this or if you're letting it roll over, then you kind of have to recognize what's been used because there's a chance that you're going to have an obligation to let that customer use that in the future outside of your contract term. This, again, I'm trying to think, Priyam, to your earlier question, if there's any edge cases. This one, again, is more recently becoming a thing. But in the past, I've had some experience where a business will mandate that the way that they sell to customers is you're allotted a certain amount of quantity to use during an annual term. And they put processes in place on the back end to monitor to say, once you get to 75%, we're going to essentially have a conversation with you to assess if we need to give you more capacity. And then alternatively, they're looking at when is their unused capacity, and they recognize on a straight line basis. And then again, at the end of the reporting period, they look at any of that unused capacity and say, have we over recognized significantly? So this one is a little bit more of a kind of business decision, business process to implement. And that's where tools are super helpful because you can decide what you want the business practice to be and then just have a tool support that and have the back end reporting to prove to auditors that, yeah, maybe I didn't do the exact technical way, but here's why it wouldn't be materially different. And it's all about having the data to support your arguments as a business.
That makes a lot of sense. And I think a lot of the RevRec use cases are about the story than the numbers itself. And there's a little bit of art and of course a lot of business sense to it, but you can't just pick one use case for everything and go with it. So I think that's what makes accounting interesting as well. So that's definitely the case. Awesome. I think we have covered three use cases. So thank you so much, Jill, for covering that. We have two more to go, but I would like to bring in Ashrita now to show the audience of what Zenskar actually handles and how it does it in these scenarios. And again, would love to hear questions in the chat if there's anything that we could cover. But over to you, Ashrita.
Yep. Thanks for that, Priyam. And thank you, Jill, for that elaborate breakdown of these use cases. And honestly, I think these are some of the most commonly complex use cases that I usually see on a day-to-day basis when we talk to the customers, right? And the main idea that the customers come in with is to actually, hoping to actually automate this specific structure. And that's what I will be actually walking you through as well. Right, so we can take it step by step in the same fashion that you have just mentioned, where we can start off with, let me quickly share my screen here. And yeah, I hope my screen is visible.
Yeah.
Okay, awesome. So here again, Zenskar is a platform which will automate everything from your order to cash. So once a contract is signed on your system, all the downstream processing of invoicing, revenue recognition, analytics around that, dunning, communications, all of that is something that Zenskar would be taking care of. Now, coming to the base, Zenskar pretty much is built on the contract structure. So what I mean by that is contract in Zenskar is essentially any agreement that you have with your customer where you define what are the different products or services that your customer has signed up for, what is the billing frequency, what is the pricing that you've agreed on, payment terms, etc. So this pretty much defines the agreement that you have with your customer. Now, why this is important is because the accounting system that Zenskar has is built on ASC 606 and is pretty much tied to the contract structure and completely independent of the invoicing. Now, the reason why I specify that is in the use cases that I believe, Jill, you have briefly taken up before, where we have these multiple hierarchy structures where the service is actually provided to one entity, but the invoicing is done to the parent entity. Or in cases where there are contract amendments and you can pretty much have control on when and how do you want to send out the invoices. But the revenue recognition should not be tied to when these invoices are sent out or whom these invoices are sent out to. Right, so that's exactly why I mentioned that the contract and RevRec are completely coupled and the invoicing is completely decoupled. So taking this example that you mentioned first, where we have the implementation plus subscription bundle service, where you also spoke about how there are various ways of handling this, where you can either have them as separate performance obligations or clubbed into one. So that's exactly where we have the accounting system coming in, where by default, based on the contract structure you have set up, the performance obligations for the same will be automatically created. Now, these performance obligations are created based on certain default rules that we set up, but at the same time, you have the ability to override them at a specific contract level too. Right, so here, if you see, your subscription is pretty much a straight line distribution, whereas your implementation fee, which in most of the use cases that we see is usually like a one-time, point in time recognition. Right, so Zenskar provides you with that flexibility to define how each of your product has to be recognized, if it is point in time or if it's overtime distribution, where you can define if it's equally based on months, usage-based, entitlement-based, etc. And it will also allow you to go ahead and define if you want to club multiple products into the same performance obligation. Right, so this is exactly where you have the ability to choose, if depending on how your business functions, if you want to split these, implementation and subscription or any other fee into two separate performance obligations, or do you actually want that to be considered as one? So these are the rules that you can define on the platform that will automatically automate this for you as soon as the contract is created. Hope that makes sense. I will quickly pause to see if we have any questions from the folks here.
No, we're good so far. I think you're doing a good job. Let's go with the flow.
Perfect. So I think the second part that we were speaking about is the hierarchy structure itself. Now, when we speak about customer hierarchy, this is actually a pretty complex case where we have various use cases that we usually encounter, where you have use cases where the contract is with the parent, but the children are invoiced, or the contract is with the child, but the parent takes care of the billing, etc. So in these use cases, how do we handle? And of course, in the interest of time, I'm going to take the most common scenario that we come across. That is, the parent and the child have their independent, contracts, but at the same time, parent is responsible for paying the invoice for the customer. Right, so that's why we have the parent-child hierarchy set up as well. And of course, this can go to multi-hierarchy level too, where once you relate a parent and child together, whenever there is a contract that's getting created at a child level, you have the option to choose who is the billing entity, right? Who should the invoice actually go to? Now, with this, what we do is the invoicing is, again, like I mentioned, decoupled. So the invoice would be sent to the parent, but since the contract is actually at a child level, the accounting, the revenue recognition would actually happen with the child itself. So essentially, falling back to ASC 606 rules, whoever we are providing the service to, that's exactly where we are recognizing the revenue as well. Right, so that again, in what we see in most other vendors is the RevRec is tied to invoicing. So whoever you are actually sending the invoice to, the revenue is recognized at that entity. And that's exactly what we made sure to specialize in, to keep these specific items separate, where the invoicing and the RevRec are completely decoupled. Right. So that's about the hierarchy structure itself. And I think the last part that I quickly wanted to touch up on is these contract amendments that we're talking about, and how Zenskar gives you the flexibility to automate handling that too. Now, whenever we are setting up these rules in the system, one major factor that plays in the automation part is the adjustment of closed revenue difference. Now, this going back to one point that Jill has mentioned before as to how do you actually want to recognize the revenue? Do you want to straight line that throughout the contract period, or do you want to backload it? That is, you recognize all the difference at the end, then decide what to do with those specific credits, or any quantity that you're working with. Do you want to issue a refund, or do you actually want to recognize the full revenue at the end? That's exactly where you can predefine these rules as well, so that whenever there is a contract change, and if there is revenue that is pretty much logged until a certain period, how do you want to handle that closed revenue difference is something that we can predefine here. So front load is pretty much recognizing it immediately in the next in that particular period. Straight line is so that we do not see any spikes in the revenue. That difference is spread equally across the remaining contract period. And then we come to backload, that is throughout the contract period, whatever changes are there, we would essentially recognize it at the end of the contract period. Right, so at a high level, this is what the rule library of Zensker entails, and I think there are more use cases to cover. So I'll again pass it over to Priyam to cover the rest of them.
Yeah, Ashita, I think we have a question on the parent-child entity. So the question is, what happens when a child entity churns? Do you reallocate the transaction price across the remaining entities?
Right. So Jill, probably I think I'll pass it over to you to talk about the best practices here.
Thank you. Yeah, it depends. It really it does depend on if the agreement says that the customer can reallocate that to a new agreement. So let's say they had $100,000 remaining that they terminated on one part of it. If they can go and allocate that to maybe a new entity or subsidiary, whatever, then that's going to just be held as your deferred revenue until that's reallocated, right? And then at that point in time, you would start RevRec again. Assuming, it's all one for one, right? They're getting the same exact service as the other entity would have gotten. However, if it's like, hey, you kind of just lost that money, then you recognize that all at that time. The time that you basically receive notice that that entity is no longer going to be part of the contract or whatever it may be. And then the third scenario would be if you don't, maybe they were like quarterly payments or something where you haven't actually invoiced them for the remaining balance, and you just say, okay, we just basically no longer have an agreement. I won't invoice you anymore and you don't owe me anymore. Then in that situation, you would have to go through and make sure that from an allocation perspective, that your remaining revenue isn't more than kind of what your new total contract value is. But in most SaaS organizations, you're not going to have that because it's everything straight line. So whatever was remaining to be invoiced, you haven't recognized it yet anyway. So it's just basically a reversal of the deferred revenue.
Interesting. That I definitely think is a very complex use case to kind of figure out. So thanks for asking that. Awesome. Moving on, I think we can move on to the remainder two use cases that we had planned to cover. So I'll share my screen once again. Is it visible?
Yep.
Awesome.
I
So
see. Yep. Mid-contract upsells.
yeah, over to you, Jill.
Okay, perfect. That is our next one. Okay, so I think this ties in really well to what we've already talked about, a lot about the contract modification. So mid-contract upsells with a different price. This one can be a bit tricky. I would say if we want to focus on edge cases, most SaaS organizations ensure that they're selling any upsells at a similar discount. So it doesn't have to be the exact same discount, right? You don't have to say every discount is 10%, but let's say it's a range of like between 10 to 15%. That customer always gets about that discount. Then you wouldn't need to impact your current contract, right? You can essentially say this is a new contract and there is no impact to that. The exception there would be what we talked about earlier was with implementation, right? If there's something that you have to do in order for them to use the product, then you have to go through a contract modification evaluation and figure out, did you over recognize revenue based on those different obligations essentially that are now new that you didn't know about before. But you have to look at the accounting and assume you knew about that before and evaluate what's the difference in the RevRec for those periods that have already passed. So if, again, you're in a scenario where your discount is outside of, let's say, that range, so maybe you give something away for free, it doesn't really matter the opposite way, right? If you overcharge somebody for something, then that's just typically a separate contract, assuming that, again, your performance obligations are separate. But if you give something away for free, or let's say you just give it away for $1, right? Like a very different discount than what you've given that customer historically, then again, you'll need to go through the contract modification guidance and evaluate, did I over recognize or under recognize potentially revenue in prior periods, and then basically make an adjustment and then recognize that going forward. There are some policy elections there, right, around if it's retrospective or prospective and how you handle that. Have not seen anybody really say that they can just get away with not doing anything retrospectively. But that comes down to materiality. So there is always that argument as well. Okay, I think that's mid-contract. Any questions that you got, Priyam, on that one?
I think I have a question in the Q&A, but I think that's what the next use case. How do you handle transition when you change your rollover policy mid-contract? I think it's for the scenario we covered previously on mid-contract changes. Oh no, it's about this only. So yeah, we can cover that.
Okay, can you read that one more time to me?
How do you handle the transition when you change your rollover policy mid-contract?
Okay, I think what we're saying is that maybe we didn't we didn't think we would allow rollover, and now we decide that we're gonna allow rollover. Hopefully they can
Yeah,
confirm that's the question, but that's the way I'm understanding it.
yeah, we can wait for them to clarify in the chat, but you can answer on I think a change in rollover policy sounds something like that. So we can consider that and answer that.
Yeah, yeah. So that again would be sort of a contract modification, because essentially what you're doing is, let's just take a very simple example. Let's say you have a 12-month contract. It's $120 for that 12 months, right? So you're recognizing on a SaaS agreement, right? You would recognize $10 every month. But let's say you're recognizing what they actually use every month. And at the end of the contract, you have $20 left over. And you agree with the customer, like, hey, we're going to give you 2 more months to use that. From an accounting perspective, what you now have to do is say, okay, my original contract, picture a spreadsheet in your mind. My original contract was $120 over 12 months, so it was $10 every month, right? Now we're saying actually it's $120 over 14 months, right? And so my RevRec would not be $10 every month. It would be like whatever that is, $8 every month. And so you essentially would say, okay, where am I at in the contract? If I'm, let's say, in month 11, what have I recognized to date? And then again, that's where the materiality comes in. So if this is like on one contract, you might say like, whatever, it's like, it's a $2 difference and I make $100,000 a year, right? And so the $2 is not material. I don't really care. I'm not going to book an adjustment. But if it is material, then you would actually have to go and book an adjustment and reduce revenue for whatever the previous period was, right? And if you're a public company, that includes reporting. So if you're like, oh, I report it quarterly, that this was my revenue. Well, now you have to go back and say, well, actually, quarterly revenue would have been this. And so that's where restatements actually come up. And again, It's the benefit of materiality because you can get away with like doing that for one-off contracts. And so that's again where it's really important that the business has a policy and that you stick to it because when you keep rolling those things over, it almost becomes impossible for you to have a revenue number that's accurate, even historically, because you've changed your obligation over every contract term, essentially.
Yeah, that's a good one. I think rollover policies are one of the most interesting ways to keep customers invested and, making them think that they can use the credits eventually, but it makes accounting and everything around revenue really, really difficult. So having policies in place beforehand, I think, is a major takeaway. Um, awesome. I think we've covered four scenarios and we can move to the last one, per seat overages with real-time additions. Jill, over to you.
Okay. So this actually, this is again along the contract modification lines of a revenue policy, but you also are going to need to think about this from a performance obligation perspective and a contract perspective. So what I see a lot of SaaS companies do is argue that any of these additions to the contract, like one additional seat, or, let's say like I'm going to use one additional credit, whatever that may be, that those are separate buying decisions by the customer. And therefore, it's a quote unquote separate contract. So you don't need to impact what was already recognized because this is basically the customer paying the same price and they're just using a little more in any given month. And so what a lot of SaaS companies will do is if we think back to my $120 example, they'll recognize the $10 every month. And then if a customer comes and says, well, I want to add one more on, they say, okay, well, now instead of $10 every month, it's $11 every month that we're going to recognize because we just added one additional on, right? We don't need to go back in time because this is a new contract, a new obligation where we're now giving them different and new service, right? That's like a new transaction. But again, that kind of has to do with how your product operates. But for many SaaS companies, that's how they treat it as a new transaction and it doesn't impact your historical RevRec. You just basically add it on as not a new subscription, right? But a new transaction to that existing subscription.
Interesting. That's helpful. Do you want to cover the usage-based revenue as well, or I think you already touched upon that.
Um, yeah. So, oh, yeah, we talked about this kind of earlier, but I'll touch on it here as well. So, if we think about the variable consideration conversation from before regarding how much do you think a customer is going to use, right? If the customer signs up for 100,000, it's very rare that you're going to say, oh, but I know they're going to use 200,000, right? Like, unless you're like a magician, it's very hard to know that. And so, under the technical accounting guidance, it says at the onset of the arrangement, you should estimate what you think they're going to use, right? And so, when you think about overage revenue, the technical guidance could get you caught up where it's like, oh, I have to estimate how much I think they're going to use over the term. But that's not reasonable to do. And so that's why there's points in the guidance that say, this is a separate purchase decision. My obligation is now a new obligation. So it's a quote unquote separate contract, and I don't need to really impact any of the revenue that I've already recognized. But there's definitely points like I I recommend to people when you get into these kind of edge cases or these scenarios to just have a simple revenue memo or policy that outlines how you're accounting for it. So that if you do go through an audit or somebody asks how you're doing it, that you have an outline of what your policy is. Because there's points in the accounting guidance that basically allow you to get out of different requirements. And so outlining that stuff is always very helpful to get everybody aligned with how RevRec is treated.
That's interesting. That makes a lot of sense. And I see how these scenarios are so on the edge that there's a lot of context and the business nuance and how you want to report something that decides, how the revenue will be recognized. Of course, there are guidelines, but there's still some room to play with. So I hope audiences taking that, how to kind of decide on those lines and take it away from here. Awesome. I think we're towards the end. Maybe, I would like to invite Ashita once again to show how Zenskar can handle some of these edge cases. Ashita, over to you.
Yeah, thanks, Priyam. Actually, the usage-based RevRec, as well as, I mean, that usage-based piece is not really complex just for RevRec, but also on the billing standpoint, right? So that's actually one of the spaces where we excel, where Zenskar is pretty much built specifically for usage-based pricing. I mean, of course, covering the various other types of pricing models as well. But the reason I say that is we have a specific usage metering piece that will allow you to, choose how exactly do you want to ingest the information without too much engineering overload. And this is, applicable both on the invoicing side as well as the revenue recognition side. And for the use cases that we just discussed, where if there is increment in seat, or let's say in this specific use case that I've taken, if my invoicing is based on certain quantity, that in this case we're looking at API calls or number of seats, number of users, number of licenses, which we usually see varying over time. How exactly do we handle revenue recognition for that is another interesting piece here. Right, so in the distribution methods that we see itself, we have what we call as usage-based revenue distribution, where this is specifically built for the pricing models that we have just covered. Right, so in this case, where we are looking at $2 for the API count, and this is a small example that I've taken where this specific customer has used, let's say, 100 units of that API call. Now, how would we recognize that? With the usage-based revenue recognition, we would actually recognize the amount that has been incurred in that particular month, and not just straight lining it over time depending on the estimated transaction. Now, of course, we did have customers who came up requesting for that use case where they actually go ahead with an estimate and not really the actual usage, which is why we have incorporated that particular rule as well, where you can go ahead with an estimated transaction price, and whatever difference that you notice can be recognized at the end. But at the same time, the ideal way of actually handling it is, because you would be sending us the data real time, either via APIs or the different data source connectors we have the ability to actually recognize it real time as and when you're sending the data, based on the actual consumption and not just an estimate. Right, so this completely eliminates the point of you manually revamping every time a change has occurred in the contract, but we would essentially be keeping a track of that and automating the revenue recognition side of things for this. Right, so that I think pretty much sums up the various use cases we are looking at. But just again to talk about briefly about the contract amendments, essentially what Zenskar does in the background is whenever there is a contract change, we recalculate the entire contract value and then reallocate the amounts here. So that's exactly why we have the automation of adjusting closed revenue as well. This is a small example again, where initially the contract value, let's say, was 1,000 per month over a period. And next, when it moves to 1,500, retroactively, do we want to change that amount is again a business decision. And if yes, then how do we want to handle that moving forward? In this case, we are backloading it, which is why you see the difference being recognized at the last month. Or if we go with a straight line of front load, you would see that equally distributed throughout the remaining contract period. Right, so I think that pretty much sums up all the use cases we've discussed. And Priyam, again, over to you.
Awesome. Thank you so much, Ashita and Jill. This has been incredibly valuable. All right, I see a couple of questions in the Q&A box and the chat, but before we get to that, I said at the beginning of the webinar that we'll be giving away $100 Amazon gift cards. So I think I would like to announce the winners and then we can answer a few questions. First of all, thank you so much everyone for sharing some of your questions in Q&A, in chat, on DM. I really appreciate this. I think taking the winner's name, sorry if I'm pronouncing them incorrectly, but I think the first one is Hung Fam. I also already see a question from you waiting in the chat to be answered, so congratulations on that. And the second would be Bronson Yoder. I hope I'm saying your name correctly. Apologies if I'm not. But congratulations. We'll be reaching out to you directly after the webinar to share the gift card with you. Um, I think, Jill, we can take a couple of questions that I see in the chat. Should we start with the one from Hung? He's asking, they're asking biggest challenge is managing our component pricing, the usage bit, and making sure our RevRec policies reflect the obligation fulfillment. I think that's more like a suggestion, not a question. So I think I can move to the next Q&A in the chat, in the Q&A. So the question is, if you sell custom applications or workflows that can be built for your customer, does this need to be recognized as a separate obligation if it can be used in conjunction with the platform? Oh, that's a pretty nuanced use case. Jill, do you have an opinion on that?
Yeah, I think if I understand correctly, it's like the customer can build on their own, but you can also build for them. Maybe is that the way you understand that, Priya? Maybe like if we think like a website build, right? It's like you could do it on your own, but we could also just do it for you.
Yeah, I think that's
Is that kind
custom
of what?
applications, workflows, something like
Yeah.
that.
Yeah, okay. That's a great question. And I would say that those are two separate performance obligations, because basically you have one obligation to just provide that platform for them to create whatever they're creating, workflows, etc. And then your other obligation is to actually build something for them. And so the build part is either an implementation or a professional service. And so you would have to decide, you know, in those two separate performance obligations, when you turn the service on, so you turn the platform on, that you can start recognizing a subscription type of revenue because you have allowed them access and they can do whatever they need to with their workflows. And then the second obligation you would recognize as you deliver that service. So that might be a percent completion, right? So maybe milestone based. So you're like, every time I do this, you can use a little bit of it. So I'm going to start recognizing revenue, or you might have to wait till the end of that implementation or that workflow creation, and then you would recognize the revenue. So it's very, very product dependent.
Awesome. I hope Hung found that hope helpful. Awesome. Moving on to the last question. When you're scaling from 50 to 500 customers, at what point do you think we should think about moving from a spreadsheet-based revenue recognition approach to a more automated one? Okay, that's an interesting one. I think we hear that a lot at Zenskar, and maybe I can, add something there, and Jill, then I can pass it on to you. But I think typically what ends up happening is that when you start, spreadsheets are a great tool. They're extremely flexible. They let you do and manage things any way they want. I think they're still the best accounting tool out there for most accountants. But when it becomes, when scaling up, and it becomes about accuracy becoming a lot more important, and you have to, to close books, speed up the process, and you're not able to do that in time with spreadsheets, and there's a lot of mismatch and accuracy that you're constantly solving almost on a monthly and a quarterly basis every time that close period is around the corner. That is, I think, one of the signs where you have kind of outgrown spreadsheets. It may not be to do just with the number of customers, it could be number of contracts, the scale at which you're growing, and the complexity that sits within. And that is where I think an automated approach makes more sense. Again, a lot of which what we have shown, today for Zenskar is available out of the box. So there's a lot of capability inside, most softwares out there and Zenskar, that a lot of these complexities can be handled a lot better, and you don't need to, figure it out on spreadsheets every single time. I think that is one of the triggers when it's a time to evaluate something off the shelf and see if you're able to pick something and make it work. Jill, anything you'd want to add to that?
I totally agree with you. It does really depend, and it's not necessarily a number of customers. I would say it is more complexity based, right? Like how complex are those 50 customers or 50 contracts that you have? From my experience, before there was any RevRec tool out on the market and spreadsheets were the only option, my spreadsheet started to break around 100 customers, B2B 100 customers. Like it just, there was not a way to manage it anymore. But now with RevRec tools, my kind of like, I think my sweet spot is around 20 customers or 20 like B2B contracts is when it makes sense to start looking at automation, because that tends to be when you have some standardization across your contracts and enough that you can't manage it in a spreadsheet anymore.
Yeah, that kind of answers it. So yeah, if you're tired of managing it all in a spreadsheet, Zenskar can help. We automate the entire billing and RevRec workflows from contract ingestion to journal entries, reporting, and we handle all the edge cases like we have shown today. I'll request maybe the last poll to be launched, but if you want to see how this works for your specific use cases, feel free to book a time with us. We are happy to walk you through some of the contracts and show you exactly what's underneath. I will end this webinar, with maybe an email for us to reach out. And Jill and Ashrita, thank you so much once again for your time and expertise today. And for everyone who joined us, thank you for spending time with us. We know your time is valuable and we really appreciate this. Have a great rest of your day and thank you once again.
Thanks, everyone.
Thanks, everybody.